On January 3, 2026, a seismic event shook the geopolitical landscape. U.S. Special Forces executed a swift operation in Caracas, resulting in the capture of Venezuelan leader Nicolás Maduro and his wife, Celia Flores. The capture, part of Operation Absolute Resolve, saw Maduro swiftly transferred to U.S. custody to face narco-terrorism charges unsealed in 2020. The news flashed across global terminals almost instantly, a stark headline marking a sudden and dramatic shift in a long-simmering conflict. This wasn't merely a regional political development, it was a move with far-reaching consequences. For markets, this was a bolt from the blue, injecting a powerful dose of uncertainty into an already fragile global economy. The immediate market reaction was a textbook case of risk-off sentiment. Traders and algorithms scrambled to process the implications of a regime change in a major oil-producing nation. Initial price action in Bitcoin reflected this confusion, with a sharp, albeit brief dip from its perch near 91,000 to below 90,000. This rapid fluctuation underscored how sensitive digital asset markets have become to major world events. The question that immediately arose among investors, from institutional desks to retail hodlers, was not just about the short-term noise. The real question was deeper. What does this event truly mean for Bitcoin's long-term trajectory as it pushes toward a potential breakout? This event is more than a simple headline. It acts as a catalyst for several interconnected market forces, The capture of Nicolás Maduro directly intersects with the global oil market, a domain where Venezuela has long been a significant, albeit crippled, player. The nation's vast reserves represent a massive variable in the global energy equation. In the short term, the impact is ambiguous. Analysts like Goldman Sachs' Don Struyven note that if a U.S.-backed government takes hold and sanctions are lifted, production could edge higher, potentially stabilizing prices. This scenario introduces a measure of calm after the initial shock. However, this immediate view masks a deeper, more disruptive potential for the energy sector and, by extension, the global economy. The longer-term vision involves substantial U.S. investment to overhaul and ramp up Venezuela's oil production. U.S. companies developing those reserves would fundamentally alter the global supply landscape. A significant increase in Venezuelan output would exert downward pressure on oil prices over time. That could destabilize the delicate balance maintained by OPEC and other producers, creating a new era of price competition. This potential restructuring of global oil supply chains inevitably impacts the U.S. dollar, the bedrock of international trade. Geopolitical shocks like the one unfolding in Venezuela are often misinterpreted in the context of Bitcoin's price. The immediate, headline-driven price action creates an illusion of causality. We saw Bitcoin react within an hour, dropping below 90,000 before rebounding. This is volatility, not direction. Such events introduce sudden, unpredictable risk into the market, causing rapid price swings as traders react to the news cycle. However, these knee-jerk movements rarely establish a lasting trend. A sustained directional move, whether bullish or bearish, is almost always the product of deeper, more fundamental shifts in global liquidity and macroeconomic conditions, not a single news event. The real connection between a crisis like this and Bitcoin's price is more nuanced, flowing through secondary channels like oil volatility, US dollar liquidity. It is not the oil price itself that matters most, but the volatility of the oil price. The unfolding geopolitical drama in Venezuela arrives at a uniquely mature moment in Bitcoin's life cycle. As of early 2026, a critical supply milestone has been crossed. Around 95% of the total 21 million Bitcoin have been mined. Approaching 96% of the total 21 million have been mined. This isn't just a trivial statistic. It is a fundamental economic reality that drastically amplifies the impact of demand-side shocks. Daily issuance from miner block rewards has diminished to a trickle, leaving available supply on the open market incredibly inelastic. New coin flow can't absorb sudden spikes in buying pressure. This profound digital scarcity changes market dynamics entirely. Previously, surges in demand could be met, at least partially, by a steady stream of newly minted coins. Miners would sell to cover operational costs. Now that stream has slowed to a near halt. Consequently, even a modest increase in spot demand can have an outsized impact on price, driven by investors seeking a safe haven or by investors speculating on future price appreciation. Liquidity must come from existing holders rather than new supply. That creates a much tighter market where price can move aggressively. In times of heightened uncertainty, on-chain analysis becomes an indispensable tool for understanding market sentiment and predicting potential price movements. By tracking the flow of Bitcoin across the blockchain, we can gain insights not visible in price charts alone. A primary metric to watch is the movement of coins to and from exchange wallets. When a large volume of Bitcoin flows into exchanges, it often signals an intent to sell, as traders position themselves to convert their holdings into fiat currency or stablecoins. This can act as a leading indicator of increased selling pressure and potential price declines. Conversely, a significant outflow of Bitcoin from exchanges to private wallets, often referred to as cold storage, is typically a bullish signal. The current environment, charged with geopolitical tension and market volatility, presents both risks and opportunities for Bitcoin holders. The primary short-term risk is volatility itself. As demonstrated by the rapid price swing around the $90,000 mark, prices can move violently on a single headline. Traders utilizing leverage are particularly vulnerable. Forced liquidations can be triggered. Positions can be wiped out in minutes. Even for spot holders, the psychological strain of watching large portfolio swings can lead to poor, emotion-driven decisions like selling at a market bottom out of fear. Managing this risk requires discipline, clear stop-loss strategies for traders, and a long-term conviction for investors. Another critical risk lies in custody. Not your keys, not your coins. If the crisis were to escalate and impact the traditional banking system or lead to stricter capital controls, exchanges could face operational challenges, banking issues, regulatory pressure, temporary halts on withdrawals. Recent events should remind every holder to review their custody setup and ensure true ownership and control. On the other side of the coin, this uncertainty creates distinct opportunities. For long-term accumulators, volatility is a friend. Sudden, fear-induced price dips can present excellent buying opportunities. The ability to acquire a scarce asset at a discount during market panic is how generational wealth is often built. The key is to have a predefined plan and available capital to deploy rather than being caught flat-footed by the news cycle. This moment could be a chance to strengthen a long-term position. Furthermore, Bitcoin's core function as a non-sovereign, censorship-resistant store of value. As investors watch the U.S. effectively seize control of a nation's oil assets and contemplate the fragility of property rights and fiat currencies, Bitcoin's appeal as digital gold grows stronger. As the dust begins to settle, we can outline several plausible scenarios for Bitcoin in the weeks and months ahead. Each path is contingent on how the secondary effects of Maduro's capture play out: oil, the dollar, global liquidity. A clear-eyed view of these possibilities is essential for navigation. The first and most immediate scenario is a continuation of risk-off volatility. If the situation creates a sharp spike in oil prices and spooks equity markets, large investors could liquidate assets across the board to raise cash. Bitcoin could see a short-term dip, trading in correlation with risk assets like the Nasdaq, but would likely find strong support from long-term buyers on any significant drop. A second, more bullish scenario is the dollar weakening path. If the U.S. plan to control Venezuelan oil leads to instability in petrodollar recycling or prompts other nations to diversify away from dollar-denominated trade, the U.S. dollar index could begin a sustained decline. A weaker dollar is historically bullish for Bitcoin, an accumulating tailwind toward the $100,000 barrier. A third possibility is the technical squeeze scenario, which we have already seen glimpses of. If the market remains characterized by thin liquidity and high leverage, geopolitical news or other catalysts could trigger further short squeezes, causing rapid parabolic spikes in price, followed by sharp corrections as profit takers step in, creating a choppy, volatile sideways to upward grind between 90 and 100,000. Paradise for nimble short-term traders, Anxiety for passive holders. In conclusion, the capture of Nicolás Maduro is a significant geopolitical event that plugs directly into the core drivers of Bitcoin's value. It highlights the fragility of the traditional system and accentuates Bitcoin's role as a hard, non-sovereign asset. For holders, the core message is to be prepared, expect volatility and manage risk accordingly, especially concerning leverage and custody. The extreme scarcity of Bitcoin, with over 95% of its supply already in circulation, ensures that any sustained increase in demand will have a dramatic effect on price.